Hey, good morning, everybody. Hope you're having a great day and your second half of the year is off to a great start. I want to remind you again as we get ready to start that we are in the longest economic expansion we have seen in history, 121 months, a little over 10 years. And so what does that really mean? Well, it means that I think we need to be a little bit more cognizant of what could happen going forward. So I think that we're bringing back the free report on understanding market corrections. Because here's the deal: we're hitting all-time highs again, and we need to be prepared for the flip side of this. You don't want to be heading into retirement with your portfolio down 40, 50%. That would change your retirement strategy. So get your free report on understanding market corrections. Text the word market to 863-285-3815. And Dave is going to be with us in just a few moments.
It's 8:38 now, 22 before 9. Let's check in and see what's going on Wall Street this morning. It was a good day yesterday, not as good as it started out, but a positive day. Maybe we can keep that ball rolling one more day. Downtown Sebring, we'll go to the offices of Statler Financial Services. Phillip Statler's on the line. Phillip, good morning. How are you?
Hey, good morning, Dave. Doing well today. Yesterday was, you're right. It didn't end quite as well as it started out, but it started out, barn burners to the upside, and it gave some of that back as the day kind of ended up.
Yeah, it wasn't bad. I mean, you never turned down a 117-point bump in the Dow, but we thought it might be even bigger. Part of that drift downward to the day might have been a construction spending report that came out midway through the day. You caught that one, and I guess that was a real unpleasant surprise, huh?
Yeah, I would consider it unpleasant. I mean, they expected construction growth to increase by 0.2%, and it actually went the other direction. It actually fell by 0.8%. So that's a 1% swing in what was expected and what happened when it comes to construction spending. And you and I both know that when it comes to construction, that is a key thing for us because the real estate market is a big deal for our economy.
It is, especially in Florida, but it is all over because of the domino effect of the suppliers that provide both labor and materials to the construction industry. It and the auto industry has a ripple effect all the way through the economy when one of those two industries has a hiccup, right?
Oh, that's true. And you mentioned the auto industry. We don't have those numbers yet, but they're due out sometime this morning. We have total vehicle sales coming out today, and we have domestic vehicle sales coming out. And from what you and I have seen on a precursor to that is they're going to be softer than expected.
And the question is how much softer is going to be the thing. We don't have it. Sometimes we get pleasant surprises, but the early indications have been that we've had a relatively soft quarter on auto sales. Some of it might be the fear of increase in interest rates, and some of it might be money going in the direction of refinancing mortgages as we see the decrease in mortgage rates. But one way or the other, auto sales have been a wee bit softer than they'd hoped for the first half of the year.
Well, that's true. One of the indications of that is when they start giving that 0% financing out there, which I've seen here in the last month or so.
It's kind of got to the point where they can give 0% to a turnip these days, and that doesn't help. I kind of flippantly said that maybe President Trump was reading the same article that we were yesterday about how if things get too hot too fast, the Federal Reserve this month might hold off on an interest rate decrease. So he turned around yesterday and said, I think we're going to slap some new tariffs on Europe. And that kind of put a hiccup in the market as well.
Well, I'm sure that didn't help along with the construction spending numbers. The other thing I think that happened overnight was Australia lowered their interest rates. You know, they're one of the highest interest rate countries around. They lowered theirs by, I think it was 1/4 point. And so everybody seems to be going that direction. I don't know if that will put any pressure on the Fed or not as they look at worldwide interest rates.
And if the Fed looks at things like construction spending and auto sales and the like, instead of just watching the stock market, which we hope they aren't doing, there's plenty of evidence that we're slowing down enough to justify a little bit of stimulus. Wouldn't you agree?
I definitely think we're slowing down, but I don't know which way I'm really going to fall on that, Dave. Because parts of me think we need to leave it alone and let this contraction kick in so we can get through it and move on. And the other part of me is like, I kind of like the status quo, and I like the economy the way it is, and let's lower interest rates to keep fuel in the fire. So I've kind of got mixed emotions.
I'm kind of a fence sitter myself on that too, and I've expressed that before. I'm looking at it and saying, okay, we're still on the low end of the historic range for Federal Reserve interest rates. And, while we're okay right now, we're obviously slowing down. I'm not necessarily in favor of raising them anymore, but let's not take too many tools out of the toolkit before we find how much trouble we're in.
Well, yeah, and I'm sitting here watching the 2 year and the 10 year Treasury. The 2 year is getting very, very close, or the 10 year is getting very, very close to crossing back over the 2% mark. It started out this morning at 2.03. It is currently at 2.005. So some things there we need to keep an eye on, and then the 2 year is relatively close to where it opened, but it's down just a little bit.
Yeah, there's a little bit of retrenchment back on the yields on the bonds. That's true. Talking on the markets, probably the biggest excitement level that's going to come out in eons isn't even on our stock markets. The Hong Kong market is going to be debuting the IPO for the people that bought Anheuser-Busch a few years ago. InBev is actually going to go public. I think some of the money flowing might end up going to the Hong Kong exchange in the not too distant future. They're saying that could be the biggest IPO we've had since Alibaba.
Well, yeah, they're saying definitely be the biggest one this year. They're talking about it being nearly a $10 billion deal on the Hong Kong exchange. And I got to think that's a pretty big deal.
That's going to suck a little bit of money out of our exchanges too, because we like our beer and we like our beer stocks, and InBev pretty much has bought all the brands worth buying these days.
Well, that's true. They've kind of become a conglomerate of the beer industry, but I don't see anybody trying to break them up.
Well, that's true. It's nice to be centered in Europe when you got something like that going on, isn't it?
Yeah, I mean, everybody wants to break up Facebook and some of these other companies, but they don't even look at a company like InBev and think, well, geez, they've got too much of market share.
Which politician do you know of that's willing to raise the price of beer anytime near election time?
Well, that's probably true. That's
Mess
probably
with
true.
our market is one thing. Increase the price of our beer, that'll turn the bums out, momentum going at a heartbeat. One thing, we've been watching the price of oil, and it's kind of interesting. We were swapping yarns on this based on the news articles. The OPEC countries got together yesterday, and they actually, believe it or not, actually agreed on something for a change, and that's to cut back production and maintain production cuts in order to support the price of oil. A big chunk of that because we're producing enough right now in this country, so we're pretty much energy independent if we want to be. That was followed suit by the non-OPEC countries too, so I don't really see a lot of light at the end of the tunnel for the upper 50s on oil prices. Do you?
No, I don't either, but it is trailing down off of where it was yesterday by about 1% this morning, and the other day we were up at over 60, so any kind of retrenchment we get will be definitely appreciated on that front. Hey, the other thing I did see, Dave, we didn't talk about this before we went on there, but we're seeing a little bit of a contraction in company buybacks
Really?
of stock. Yeah. So I read two articles. One was saying, what is that really telling us? And is it important that we're seeing companies starting to back off of their buybacks a little bit? And it was kind of cautionary. And the flip side, I saw another article that came out and said, well, you have to really look and see why are they doing it and what aspect of it is. And really, if you look at the last 5 years, yeah, it's down from last year, but it's really not down from 3 of the last 5 years. So there's some mixed opinions there of what that really means.
I got to believe that if I were a corporate CFO and I saw my company stock on the high end of its range, I'd say I'd rather hold capital and use my stock buybacks to support an underpriced stock than buy one that's at, let's just say a fair market value for its price as well. Might be the price of the market. It also possibly could be the fact that the corporate buybacks have gotten an awful lot of political blowback saying that's all the Trump tax cut has done for corporate taxes is turned into more stock buybacks. So politics might factor into that a little as well.
Well, and that could be, you're right, because we're coming up on election time again. So politics starts to play a little bigger role in all those things.
Understood. So setting the table for this morning on a really relatively quiet news week, and it's going to get even more quiet tomorrow with only a half a day of trading. Yesterday it was green ink time. The Dow was up by a little under 0.5%, up 117 points. Standard & Poor's, we should note, set another all-time closing record at 29.64 and change. It was up over 0.75%, up 22. And the NASDAQ is continuing its recovery, up better than a full percent yesterday, up a little under 85 points. We kind of hinted at the fact that we're not going to go that direction today. Some of it's going to be an urge for profit taking. Some of it just some not necessarily optimistic news that came out of the reports that we had. 45 minutes before we start throwing money around, Phillip, where are we going today?
So the major indexes are all in the red. I'm not going to say by much. They're pretty pink, as a matter of fact, because the Dow is down right now at $19. Not much. The S&P 500 is down less than $1, and the Nasdaq's down $4.50. So everything is at less than 0.07% down right now. We've got gold trading back up just about 0.25%. And we do have silver getting close to that $15 mark. It's at $15.09 right now, down about 0.7%. And then the one you and I like to see going down is going down this morning. It's down about 0.8% to $58.59 a barrel.
I wouldn't mind seeing that become a trend, but I'm not optimistic. I still think we're stuck in that upper 50s trading range for a while with the production cutbacks on OPEC's front. Wouldn't you agree?
Yeah, until somebody starts cheating.
Yeah, and that takes about 20 minutes generally when we're talking OPEC. We mentioned bond yields are sliding again this morning, indicating there's a little bit of flight to safety going on. Overseas markets, Asian rim markets almost to a T were up this morning. European markets mixed halfway through their trading day. Things are weird. Things are breaking all the usual rules of thumb, Phillip. Retirement accounts are something that's mighty precious to keep stable. How do I find you for some advice?
You know, now's a great time to do your financial x-ray analysis. Schedule your free appointment for that at 382-0037. Now, we're also going to flip back now and offer our Understanding Market Corrections Report. Since we hit new highs yesterday, I think this is vitally important, especially if you're 5 to 10 years out from retirement or you're already retired. To get your free report, text the word MARKET to 863-285-3815, or if you're on Facebook, click the link right above this video and it'll take you right there. And then catch us every weekend for the Statler Financial radio show, noon on Saturdays, 10 a.m. Sunday mornings on News Talk 730.
All righty, we stream News Talk 730. If you want a nice surprise, log on to our website at 1057lightfm.com, and we might have a surprise on that for you as well. Phillip, I will see you tomorrow morning, all right?
All right, buddy, you take care.
Thank you so much. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, again, folks, I want to thank you for joining us today. If you like what we're doing, please like and share this video with your friends and family. And don't forget, text the word retirement to 863-285, text the word market to 863-285-3815. You can tell these are unedited. You're going to get the good, the bad, and the ugly. Take care. Hey, I'm not going to be here tomorrow. Have a great 4th of July holiday. Continue to make America great.